Good morning. Thank you for joining us today as we walk through mastering the first sale rule. Before we get started, we have a couple of housekeeping items for our attendees. On your screen, you're going to see a sidebar to the right of the main stage. So if you're having any technical issues or need assistance during the webinar, my colleague Carol is going to be there on the bat line. Drop a message in the chat and she can help you out. There's also in the menu above your screen, you have two tabs. The first tab gives you an option to download the slides from today's webinar. Definitely take a minute to do that. And then on the second tab, there's a brief survey for the webinar. We'd love to hear your feedback about this webinar or anything else that you'd like to see us present on. At the end of the webinar, we will host a short Q&A. So as you have questions, don't be shy, drop them in the chat box, and Carol is going to help us get those teed up at the end so we can look at your questions and try to answer as many as we can. Anyone attending this webinar can earn one CCS Certified Custom Specialist credit. So we're going to post a code in the chat towards the end of the presentation so you can get that credit for attending today. So a quick a legal disclaimer. As with all customs analysis, many of them are fact specific. So don't take our presentation today and use it to implement a first sale rule program without doing the necessary diligence. Definitely contact Flexport if you need help with that. We have a nice team that can assist you with that. To introduce myself, my name is Anna Zajac. 20 years in the industry working in as a broker, have my roots as a broker. I'm a licensed broker. I'm also a certified public accountant, and I work in Flexport Trade Advisory practice. And my colleague Tom is joining me today to walk through the presentation. Tom?
Hi, Anna. Thank you very much. Yeah, my name is Tom Gould. I'm Senior Advisor for Customs and Trade to Flexport. And I'm a licensed customs broker, certified customs specialist, and have been advising companies on duty saving strategies and customs compliance for more than 30 years.
Great. Thanks, Tom. So maybe we can just go ahead and kick it off to the table of contents. Sorry, I'm having a technical issue here. So we're going to walk through the slides today, and in this order, we're going to just talk about understanding the first sale rule, what it is, what are the potential benefits for using it, how to implement the first sale rule, and then some specific considerations for intercompany sales and for successfully implementing a program. And we'll close with ways we can help and a Q&A. So Tom, what the heck is the first sale rule?
Sure. So the first sale rule is something unique to the United States, and it's unique to U.S. Customs. The rule is a rule that allows companies that are purchasing products for import where there are multiple sales involved. Generally, when we refer to the first sale rule, we talk about two sales, but there can be more than two sales. And the first sale might be from the factory that actually produced the product to some type of a middleman or trading company. And then the second sale would be the sale from that trading company to the actual importer of record. Now, in traditional customs, traditional customs entry, we as a customs broker will use the last sale in a series of sales for the declaration that we're making to customs on behalf of our clients. So if there's that sale from the factory to the middleman and then the sale from the middleman to the importer of record, when we file the customs entry documents, we will use the sale from the middleman to the importer of record, and we will provide the invoice that documents that sale to customs when we file the entry. The idea behind the first sale rule is the first sale rule will, as long as the conditions are right and as long as the rules around first sale are met, it will allow a company to use the sale from the factory to the middleman company as the basis for the customs declaration and the basis for calculating the amount of duty, as opposed to the second sale. Now, assuming that the first sale is going to be at a lower price than the second sale, that it is acceptable to use that first sale price and pay duty based on the first sale price. And a little bit later on during the webinar, we'll talk through a few examples, but that's the basic idea behind the first sale rule. And with the recently imposed additional tariffs, including the Section 301 tariffs, the 232 tariffs, and other tariffs, uh, uh, the first sale rule allows companies to save a little bit on the duty spend.
Yes, definitely can have a stacking benefit. And you said this is a rule only available in the US, Tom?
Yeah, it's a rule that's only available in the U.S. And if we move on to move on to the next slide, we'll see a little bit about the legal precedent. The rule had been available in other countries, but other countries that have, notably Europe, Australia, they've changed their laws to no longer allow this. The U.S. still allows it, and it's a rule that came about because of the way that the language is written, the way that the value rules are written, and the value rules in the U.S. say that the value that's declared to customs is a value based on the sale for export to the United States, not import to the United States, but a sale for export to the United States. Now, there have been a number of court cases. The first and most important one, is a case where Nisho Iwai, a trading company, sued the United States, and the Court of International Trade basically said that it was acceptable to use that first sale in a series of sales as long as certain conditions are met. And primarily, the conditions are that the sale that's declared to customs has to be an arm's length transaction. It has to be a transaction value, and it has to be a transaction value that is acceptable to customs as a arm's length transaction. Um, so if the transaction is between unrelated parties, it's generally fairly easy to demonstrate that first sale price is an arm's length transaction. But if the sale is between related parties, and I can tell you from my experience that many first sale transactions are set up where that first sale is between a related factory and a related middleman. And so in those situations, companies have to be able to demonstrate to customs that the transactions were conducted at arm's length, meaning that they were negotiated fairly the way that they would negotiate a contract that was not an arm's length or that was not a related party transaction. And then the second requirement for the first sale rule is that the merchandise at the time of that sale, of the first sale, that the merchandise must be clearly destined for export to the United States without the possibility of diversion. So I've seen situations where companies might order products from a factory, and the products, some of them will be sold in the U.S., some may be sold in Canada, Mexico, or other countries. In the case of a first sale, the transactions need to be set up so that there is no chance of diverting the goods to another country. So that those are the primary rules behind that were determined in the court cases that led up to allowing the first sale rule to happen in the U.S.
Yeah, oftentimes you see this. It's not just with big companies that can use for sale rule. Oftentimes you have an entrepreneur has maybe a patent or has produced a unique product, and they control the supply chain for who produces it, and then they establish an affiliate company in the U.S. To be the official distributor in the U.S. or in other markets. But so whether the middleman, if you will, is the entrepreneur or another party, sometimes all three parties can be affiliates just because of the way that
Yep.
supply chains are integrated today.
Good. So you want to talk and a little bit about the calculation and how companies can understand how they would save?
Yeah, sure. So, Tom said to us, transaction value method under the customs rules is just basically valuing goods based on the invoice price, right? Which seems simple enough. I bought the goods for $100, so that's what I declared to customs for customs purposes. And globally, transaction value method is used in 90 to 95% of all import transactions. So, using our example here to kind of help do some back of the envelope calculations on what that could look like, we assume a product has a 5% normal trade relations rate of duty, which is basically the column 1 tariffs that you see in your tariff schedule. And then we're going to assume a 25% tariff and that the product is from China. So Section 301 tariffs apply also. So the effective duty rate is 30%. So when you file the customs entry, your basis is really that invoice price, your purchase price for the goods. So if there were no middleman and transaction A was between a manufacturer and an entrepreneur selling their goods to the US, the invoice price would be $80. So using that 30% rate of duty, the total duties owed would be $24. However, because there's a second sale that occurs and the actual importer record is company B, the sale between the middleman and company B is now $100. So if we assume an invoice price of $100 per unit, the duties owed per unit now becomes $30. So, or $6 per unit cost of good. So you can quickly see that if you take your $6 savings and multiply it by the average number of units you expect to purchase this year, it can give you a nice back of the envelope calculations for what that potential savings opportunity looks like. Next slide. So just one thing that I think is pretty interesting, we found a 2009 International Trade Commission report issued to Congress, which is dated, but at least as of that time, approximately 2.4% of all U.S. imports were valued under the first sale rule, which is pretty interesting. It's bigger than I might have thought. And I know a lot of companies don't think it's worth it, but when you look at it in this context, it seems to be broadly used across a wide range of industries, including industrial, electrical equipment, textiles, and machinery, food, even food and agricultural goods or raw materials. Next slide, please. Another interesting revelation in preparing for this presentation is that first sale rules, there's no correlation between first sale rule use and the duty rate. So some people might think like, why is pharmaceutical products on this list? They basically pay no duty. They're on here because a lot of pharmaceutical ingredients, not the actual drug product themselves, are dutiable. But also the highest usage of first sale rule is for machinery and computers, which has not a high rate of duty. Whereas if you compare that to apparel and even beverages, which often have a 20% plus rate of duty, you would expect them to be at the top. So I think the correlation that we can drive from here is really more values. Even if the duty rate is not high, companies were always claiming first sale rule based on the value of the product, it seems. And Tom, I think, this number, Tom and I were talking about this before the presentation today. I think this number is even higher today, right?
Yep. We don't know because Customs doesn't publish official statistics on this, but our understanding is that the numbers of companies that they're using the first sale rules have increased significantly over the last 5 years, or 5 to 10 years.
Great. Next slide, please. So Tom is going to walk us through what does it look like, because it's not enough to have a transaction, a middleman. I mean, that's the first step. You've identified that there is a possibility to apply first sale rule. It makes sense on the numbers. We've done our high level back of the envelope calculations. We can save $6 per SKU. And based on our current volume of imports, we think it's worthwhile to take another look. So Tom, tell us what that looks like.
Sure. So again, as we talked about, there are a couple of requirements, and the first requirement is that there are two sales. And one of the things that it's important to understand about the two sales is that Customs really does want to look to those two sales. And when I say they want to look to those sales, I'm talking about a situation where they're doing a review of the first sale program for a company. Now, this may happen when if a company applies for a customs ruling and asking Customs to give an opinion whether or not the first sale rule or the first sale program that the company is looking to implement meets the rules. It could also happen during a review, maybe if the company receives a request for information from Customs. And so what possibly would happen would be that Customs would do the review. And so what they're going to do is they're going to look at both sales. Potentially, they're going to look to see that both sales are bona fide sales. In other words, they have to truly be a sale, which is basically a transfer of the ownership of the merchandise from one party to another party for some type of consideration. The consideration is normally a payment, but the rules don't require it to be an actual cash transaction, but generally it's going to be some type of payment or other consideration. Now, they also want to see that the two sales are actually separate sales. So one of the things that customs refers to often in the rulings is what is flash title. Now, a flash title is when the the transaction in the two sales happen at the same time. So there's really not a clear distinction of when that middleman company actually owns the goods. So you have a transaction from the seller to the middleman, and then a second transaction from the middleman to the importer of record. If those two sales happen at the same time, for example, let's say both sales are set up as FOB Hong Kong, where the title transfers on both sales at the same time, customs has often ruled that those situations are not acceptable for the first sale transactions. So we'll often see sometimes companies setting up the transactions where the middleman will own the goods for a period of time. It doesn't necessarily have to be a long period of time. It could be less than a day, but where there's actually a transfer of title from the factory to the middleman, and then at a different point in time, a later point in time, the second transfer of title from the middleman company to the importer of record. And
Yeah, and
one
I
of
think it's a really good point, Tom, to do your upfront due diligence, because these are the sorts of things that you can identify in a proactive review of your contracts and documentation, right?
Absolutely. We always recommend to companies that are going into or looking at for sale and looking to implement a for sale program that they work with a professional, somebody like our trade advisory team, to help them set up the program in a way that it will be acceptable, because customs will come and ask the question at some point in time. Now, one of the other things that Customs says when you're looking at setting up a for sale program is that no two programs are going to be the same. No single factor is decisive. So Customs will look at each situation on a case by case basis. And they will look at each situation in a case by case basis to make that determination of whether or not those sales meet the definition, meet the requirements for sales, for first party sales. Um, the the second part, talking about sales for export to the United States, generally involves looking at the documentation, but it also can involve looking at the products themselves. So, for example, if you have a purchase order that is a purchase order from the middleman company to the factory, and then you have a second purchase order from the importer to the middleman company, Customs wants to see that those both show that the goods are destined from the factory all the way to the United States with no chance of diversion. So if the purchase order is for 100,000 units and 50,000 are going to Canada and 50,000 are going to the US, that won't work. But if the purchase order shows that all the goods are going to the US, the delivery address is in the US, and everything else shows that it's destined for the US, then in that situation, um, it helps to support your contention that the goods are destined for export to the US without the chance of diversion. Now, I also mentioned that customs will sometimes look at the products themselves. So if you have a multilingual product or a product that has labeling that is designed to meet the requirements of multiple countries of destination. So, for example, if you have a label that's written in French, it's written in Spanish and other languages, and maybe it has certifications that are required to sell those products in other countries. Well, that may be used by customs as a way of demonstrating that the goods were not clearly destined for export to the United States, and that might allow them to invalidate the first sale rule. Um, the next thing, and if we move on to the next slide, is intercompany sales. So, as we mentioned, it's common that we'll see intercompany sales or related party sales happening in the first sale because they tend to be closer to the factory. It's often the factory that will set up the middleman company so that they can take advantage of the first sale program. Now, Customs actually back in the 1990s published a Treasury decision that outlined the requirements for when an intercompany sale will meet the transaction value rules and will be acceptable by Customs to be a transaction value that is acceptable for customs valuation purposes. Now, when one of the nice things that this Treasury decision does is it outlines the information that customs wants to see. So they want to see more than just the transactions. They want to see a description of who the parties are and how they're related, and a description as to how those parties go about their negotiations. They also want to look at documentation. So generally, they want to look at the commercial documentation, so the purchase order, the commercial invoice, proof of payment, and they often want to see those tied to a third neutral party. So proof of payment might be something from the bank that shows the actual amount of the payment. And there are other documents that customs may want to look at. They may want to look at contracts. They may want to look at emails back and forth when the sales prices were negotiated, and they want to see the entire structure of the transaction in order to determine whether or not it's an acceptable basis of valuation for transaction value. It's also very common that customs will want to look at the financial records of the various companies involved to make sure that both companies are making a reasonable profit. And a reasonable profit is generally considered the profit of the parent company has to be comparable to the profit of the child company. But those rules get complex, and that's why we recommend that companies that are considering using the first sale rule work with an expert that understands how to establish a first sale program. And one of the things that customs looks at often is the circumstances of sale test. Do you want to talk a little bit about that?
Yeah, sure. So moving on to the next slide, the circumstances of the sale test is a test that's emerged in customs rulings. But before we get into that, maybe just taking a step back about, what is all this to do about intercompany pricing? So customs rules say that intercompany sales, which basically means that any two companies that have 5% or more equity under the customs rules are considered to be related parties. And in those cases, the way that companies bill each other is usually set in accordance with a transfer pricing policy. And that the basis for the transfer pricing policy sets a profit margin based on companies with similar assets deployed, like machinery, capital, et cetera, financial structure. So, and risk, structure, function, and risks of those entities, right? So when you look at that, the transfer pricing policy is really set under the income tax rules, and customs. These rules can sometimes come in, have some friction or come into conflict because the taxing authorities want to make sure that you're realizing enough profit, for example, in the US. And so the lower the invoice price, the more profit the company is realizing in the US. I'm sorry, the higher the invoice price, it can be inverse too. And the higher the invoice price or lower the invoice price affects the duties and customs taxes products, not an entity. And so the way that these taxes are handled or administered on a transaction level basis is what really creates this friction. So under the transfer pricing policy, it sort of all comes out in the wash, and then the company will look at their profits at the end of the year and they'll declare them to the taxing authority and pay their taxes. But customs is collecting taxes mid-year on a transactional basis, day to day, and on specific products. So if that transfer pricing study doesn't set a formula, a predetermined objective formula based on the products, then it's not going to be sufficient to meet the customs rules too, right? So it's always good whenever you have an intercompany sale, regardless of using first sale rule, that you have your ducks in a row in terms of, and you can support intercompany transfer pricing. So customs also looks at the way the buyer and the seller organize their commercial relations, and that simply means that, like, does the entrepreneur or the parent company dictate the policies to the U.S. company and the pricing, or is there some sort of back and forth negotiation occurring? And this can be shown in terms of like a contract process type of documentation. And in some companies, I've seen it even done with like showing emails of that demonstrate examples of how the two companies work out their pricing strategy. And it also can depend on like who owns the commercial relationships with the U.S. customer. Does the parent company or the entrepreneur set that policy or manage those relationships, or is the U.S. company free to sell the products to whoever they want? Like those would be ways to demonstrate that level of independence, that the price is not is objective and not affected by the relationship. So there's a couple of different tests that can be used to look at the specific price. So one is the normal pricing practices of the industry. And you see that often in like major industries, like there's a huge market for aircraft parts, automotive goods, pharmaceutical companies. Otherwise, you're going to be looking at the all cost plus a profit test. And that depends on who the tested party is in the transfer pricing study. If the tested party is the parent company or the entrepreneur, then they're going to be looking to say, is the profit enough to ensure a recovery of all, I'm sorry, is the sales price enough to recover all your costs and a profit? And is that profit realized similar to what that company earns on other sales to the US of goods? Sometimes those facts and circumstances don't exist, and then that's why it starts to get a little tricky. But you can go back to the transfer pricing policy and say, like, okay, who are the other comparables, company comparables, when the company established the profit margin to be achieved in the transfer pricing study? Did any of those companies make the same similar products of the same class of kind? And then you can take that profit margin and see if it's falling within a range of what would be considered a range achieved by other similar companies with similar assets, risks, and functions and products. Next slide, please. So as we stated before, transaction value is used in 90 to 95% of transactions globally. So this slide really is meant to be a nice little handout to show you the rules and some rulings that you can look at after our training today if you want to know more. But basically, when you're applying the all cost plus a profit test, Customs has said that you can use the profit of the parent company. We don't have an example of it in here, but you can also use the U.S. distributor, for example, as the tested party, and then look for the profit realized by other similar distributors in the U.S. So all kinds of creative ways to find a comparable in that regard. The regulations don't define like what is considered an equivalent profit, but generally when you look at a transfer pricing study, you'll see somewhere between 5 and 10 comparable companies, and there'll be a range of high and low. And as long as your profit falls within that range of the normal range, then that would be considered acceptable. And then which profit level indicator are we using? Customs prefers operating profit, which is really the sales price minus the cost of goods, minus sales, general administrative expenses, depreciation, amortization, and interest. So that means that the profit should cover all of those, the sales price should have enough profit to cover all of those direct and operating costs and still leave a margin that's comparable to other similarly suited companies. Although you can use gross profit, it's not the preferred. Next. So the invoice price, the transaction value, is acceptable as long as it includes the 5 statutory additions to transaction value, which are simply the packing costs incurred to present the imported merchandise, ship and present it in the U.S., any selling commission incurred by the buyer, the value of any assist. Oftentimes, an assist is just basically some sort of tool, die, mold, components that are provided free of charge or at a reduced price to a manufacturer to produce the goods that are imported. So oftentimes, since those costs are already paid by the U.S. company, they're not going to be reflected in that invoice price. And you may have to work out a system to declare them, whether it's having your supplier print them on an invoice template, providing your US broker with an ad slip to declare those costs, or you can also use customs reconciliation program later to make those adjustments. But they do have to be included. Any royalties or licensing fees, typically where you see these fees that become relevant is when they relate to the production of the product, like any patent fees that relates to the process for producing the good or the actual technology of the good itself should be attributed to the good and included in the cost, the invoice price, and any proceeds of subsequent sale that enter to the seller.
And one of the things to remember when you're looking at the assists is you have to remember the perspective. The importer of record, the company that's making the declaration to customs, is the one that has to ensure that the statutory additions to transaction values are added, even though they may not be the ones that have actually paid for the statutory additions, right? So it could be a situation where the middleman provides an assist. Maybe if we're talking about wearing apparel, the middleman company could be the company that buys the fabric and provides the fabric to the factory at no cost.
Mm-hmm.
So that middleman company is providing an assist to the factory, and that assist is attributable to that first sale transaction,
Yeah.
even though the importer of record may not be a party to that transaction. They're still required to report that addition because they're reporting the first sale transaction to customs on their import declaration.
Yeah, that's a really good point, and that's part of the whole proactive. One of the reasons that you should do a proactive analysis, and I think when things start to get that tricky, you might ask yourself, "Is this right program for these circumstances?" But definitely, if the invoice price does not reflect all of the costs, like can a process be implemented to ensure that they are included and can be reported to customs? Next slide.
So I'll give a little bit of a summary about what we just talked about. So when you are looking to implement a first sale program, the first thing that you want to do is sit down and take a look at the documentation that's going to be provided. The documentation that's going to be provided in both the first sale and the second sale. And you also want to look at the backup behind that documentation, right? So the documentation that's provided is generally what you provide with a customs entry. So it would be the commercial invoice, the packing list, the bill of lading. You want to make sure that those documents accurately reflect both transactions. But then you also want to look behind those documents. So, for example, proof of payment and potentially the analysis that's done to determine that the sales are bona fide sales and that they meet all of the requirements for first sale. If there are, when you're looking at the two different transactions, you want to make sure that you have a clear understanding of how the value is determined and how you have determined that the values that are declared are acceptable to customs. So it's important to have all of that document in advance of going into doing the first sale ruling. I'm sorry, going into doing the first sale program. Now, we always recommend that this documentation be gathered in advance and be kept on file by the company that is making the first sale declarations so that they have it readily available in case customs asks the questions. Now, in many cases, companies will actually opt to go to customs and request that customs provide approval. And they don't give a specific approval to a whole program, but you can take a representative transaction and a representative future potential transaction and submit it to customs for a ruling and asking them to confirm that transaction will be acceptable. And customs may issue a ruling saying that transaction is acceptable, and you as an importer can use that as the basis for setting up the rest of your program and using it going forward. But remember that customs will look, if they do a review on a future transaction, that they will look to that future transaction and they will look to see if there's any difference between that transaction and the initial transaction that was submitted to customs as part of the ruling. Then the last thing to do is, and this is an important area where I've seen companies getting in trouble, and that is when you have an importer that sets up the first sale program, if the first sale involves any additions to the transaction value, any assists, proceeds of subsequent sales, royalties, etc., it's important that the importer set up a process where they can declare that information to the um, to the to the customs broker that's going to be filing the declaration with customs. So it's very important that we have that all set up in advance of setting up the program. Um, and then, Anna, you want to talk about some best practices for setting up the first sale program?
Yeah. So, are we ready to implement it? So, we've put together a brief checklist of items to assess your readiness for implementing the FSR program under the FSR rule. First, do you have written procedures that are documented? Documented procedures would include what we just talked about, creating an objective pricing formula, how you organize your transactions. Have a policy in place that is strong and supports. Don't wait for customers to come in and ask you if your pricing is arm's length. Have something on the ready. Consider being proactive, having a proactive conversation with customers. You can do it via the rulings process, as Tom mentioned. You can talk to your C that you're assigned to, the Customs Center of Excellence, and let them know that you're going to be implementing a program and share the documentation with them. But those sorts of, they're definitely available. You don't have to. It really depends on the company, the mindset, and risk tolerance. But those are definitely some things to consider. And then when you implement your program, communicate your procedures and documentations. We need to make sure that all of the stakeholders in our supply chain are working in lockstep. So our manufacturer, the shipper, is providing the necessary documentation to the freight forwarder or our customs broker. The broker knows what to expect and which invoice to declare the value, and then test your procedures to make sure that they're working. Are things working the way that we expected? Like Tom said, review periodically. Has there been a change in circumstances that is going to create a problem for us? And then monitor for compliance. Next slide, please. So just quickly touching on how ways Flexport can help. The number one way we can help you is to do the documentation analysis. We could do a high-level documentation review of a single transaction from start to finish to see whether you have the documentation in place necessary to support transaction value for intercompany sales. Do the contracts support a conclusion of a bona fide sale? Did the middleman ever actually hold a title and risk for the goods, for example? Are there any contractual contingencies that might not be apparent to you that might affect the use of transaction value, such as a contract that says that you don't, even though the commercial invoice Incoterm, a lot of people rely on the Incoterms on the commercial invoice or the bill of lading, but you might not realize that oftentimes there's distributor agreements that have contract language that can counter a bona fide sale, such as consigned inventory or arrangements or requiring some other action before after you've already received the merchandise or before it's delivered to occur before title transfer. So taking a look at those and making sure that there's no external exigencies is a good practice.
Sure, and we'll also want to make sure that companies want to often look at the detail product by product, right? So is the is the one of the things that we say here at Flexport that we can do that many others don't do is we provide SKU level transaction data for all of our clients for when we're the customs broker for the client. So what that allows companies to do is to provide reporting at the SKU level. So if you're implementing a first sale program and you've got different SKUs that have different costs, different values, we're able to segregate that out in the reporting back to the company. And again, another thing that we can do is here at Flexport and the trade advisory team can do is to help companies with evaluating other duty saving strategies. First sale is just one of many strategies that we can work with. Another thing that we wanted to chat a little bit about was our ACE analysis. Now, many of you have an ACE portal account with Customs. If you don't, we strongly recommend that you get one. What that does is if you are an importer, you're allowed to, for no cost, go to customs and sign up for a web portal account with their ACE tool. And that allows companies to pull reports of data from the customs system, so from the official record. Now, what we have done here at Flexport is we've developed an analysis tool that we run for most of our clients. They provide us with access to their ACE reports, and we can go back for 5 years and we can look at the data that was provided by all of the customs brokers that filed entries on behalf of the importer, and we can determine, we can look at that data and we can analyze, looking for things like the possibility of implementing a first sale program. And we can even start to do some estimates as to what the savings would be from a first sale program. But not only that, we can look at things like classification. We can look to see if there are other duty saving opportunities available. We can look to see if there are compliance risks in the data, meaning are you importing products that might pose an elevated risk for compliance, things like anti-dumping or countervailing duties or partner government agency requirements. And all of that information is readily available, excuse me, is readily available when we do the ACE analysis. We provide the data back to you in a dashboard that allows you to go in and slice and dice the data. But we also have one of our professionals taking a look at the data and providing you with insights that will hopefully allow you to do a better job of understanding your risks and understanding your opportunities. And with that, I think it brings us to the Q&A time. And I do believe we have a few questions that are available. And the first one here, I'm actually think maybe I'll throw it over to you, see if you have a thought, is if it offers such a good per unit savings, why is it used very little? Is it difficult to proof or keep track of?
I think there's a couple of reasons. Well, first of all, there's not always a middleman involved, right? So the transaction, even if you do have an entrepreneur, when they do the initial setup, it could be that the U.S. company is dealing directly with a supplier, and so that it's just not as widely used in that respect or applicable. The other challenge that I've seen often is that, particularly when you're dealing with a trading company and a Chinese factory, or like a Hong Kong trading company and a Chinese factory, there's a flash title involved, or there's just not enough information to show that the relationship is not affected by the parties.
And
So it can be an issue.
yeah, I will also often see that it's difficult to get the parties to provide that information, right? So if you're the buyer and you're the importer and you're buying from the middleman company, you have to convince the middleman company that they need to give you the
Mm-hmm.
transaction records for a transaction that you're not involved in.
Yeah.
And that can sometimes be difficult, but it's also something that we've been able to help companies with successfully, because there are reasons why it is beneficial to the factory and to the trading company to set up the first sale program.
So we have another question here, Tom. Can you clarify again? The first sale and the second sale cannot occur simultaneously. So the Incoterms cannot be the same. Do you want to talk about that?
So that's a simplistic way of saying it. Yes, that's it's kind of right, but they could technically be the same. For example, you could have two FOB sales back to back with different delivery locations, right? So it
Yeah.
could be that the first sale is an FOB Shenzhen, and the second sale is FOB Hong Kong. That might be sufficient, but again, that's why you have to look at each transaction, unto itself. Generally, customs does not look favorably when the transactions happen at the same time, because that middleman company is not taking any risk of loss. And if that middleman company is not taking any risk of loss, then customs will generally not consider that to be a bona fide sale.
Maybe just adding to what you said, the Incoterms are not necessarily determinative of title and risk, transfer of risk. The two can occur at different points in time via contract language. So I think a lot of people don't realize that the Incoterms don't actually establish transfer of ownership. They're really more commercial terms that relate for risk. And so it's very often and common that we see that the title for the goods doesn't really transfer until sometime after the boat is on the water, for example, separate from the Incoterms. And companies have gotten really creative with using contracts in this way. One is for inventory accounting. They don't want to account for the goods on their books while they're on the water, for example. So that's why it's really important to do a complete document review, look at the invoice purchase orders, but like, what does the contract say that's separate from the specific documents?
Yeah.
So I've also seen often that the Incoterms are not being properly used or they're not implemented. They might say one thing and you're doing something completely different. So that's why that becomes more important. So, Tom, do you want to talk about the 5 statutory additions? We have 2 different questions. One person says is asking if they apply to products from China and Colombia, and the other person asks, do they even apply? Do they still apply if FSR is not used? You want to take that one?
Sure, absolutely. I think this will have to be our last question because I think we're actually a little bit over time, but we'll take the question. So the answer to both questions really is yes. So the 5 statutory additions, that is a basic tenet of customs valuation. So anytime a company imports, when they pay for the product, they declare the price that they paid, but customs requires that any additions that are on that list of 5 additions that are not included in the price paid or payable and the price declared to customs, that those must be declared separately to customs, again on the customs entry document, but those must be declared. Now that applies regardless of what country the goods are being imported from and regardless of whether or not the company is using the first sale rule. That the reason that we raise the question here is that when a company is using the first sale rule, the 5 statutory additions are required to be reported on the first sale, not the second sale, because the first sale is the one that's being reported. So again, if you have a factory that sells to the middleman company has to tell the importer what statutory additions were paid or would need to be added to the value that's being declared on that first sale value. And then the importer or the importer's broker has to make that declaration to customs to ensure that the price that's declared on the entry is the complete transaction value, including all of the statutory required additions.
That's a good point. If you're not using the second sale price, you don't have to go back and adjust it for customs because it's not part of
Correct,
the
because
value
those
declared.
because those
Yeah,
amounts are already included, right? So if the first sale is a related party and the second sale is a non-related party in arm's length transaction,
mhm.
those assists or royalties or other additions are already built into the price by the time you have that second sale.
Thanks, Tom. We did have one other question that I wanted to answer. Does Flexport do for sale analysis? We do. Our trade advisory practice consists of licensed attorneys, customs brokers, and myself, a CPA. We have lots of experience in this space, and give us a call if you have questions. So, with that, I think we're going to wrap it up. Don't forget to get your code for attending today so you can get CCS credit. Thank you all for attending. We appreciate it.
Thank you very much.